What's going on, guys? Welcome back to another video. So in this one, I have a very important update for you guys on the overall state of the market, the economy, and where I see us going over the next couple of quarters here. There's a couple of things that a lot of people are overlooking and really need to keep in mind when they are making any sort of investment decision. And I really want everybody to understand exactly what is going on here to kind of better prepare ourselves going into the next couple of quarters, because there are some very interesting things coming that we all need to be aware of. So guys, if you do enjoy the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who do want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So kind of speaking about the market crash, the correction, where we're headed, we kind of have to think about a couple of things. The first is what has actually changed. We've all seen what the market's done over the last couple of weeks. It's come from the lows at 362 about all the way up to the highs, hitting that 430 mark and rejecting back down, pretty much exactly what we said it was going to do. But when you think about market movements and large institutional money coming in, propping markets up, selling markets off, you have to think about what has actually changed in the actual economic environment. Yes, we did beat expectations on the CPI data coming out, but we are going into another period of rising interest rates, and that is going to be critically important a little bit later in this video. So the first thing that we need to kind of go over here is technically how is the market looking right now and where could we see this thing go, and then go over some of the things that you guys need to be aware of going forward. So when we're coming over to the chart right here of the S&P 500, this is going to be on the 4-hour time frame right now. So this is going to be a little bit more short term if you're thinking about where the market could go over the next 2 weeks to about a month and a half. When we're looking at this time frame here, we just slipped this 13 EMA. We're coming down to the 48, and we could easily see ourselves back down at this 200 exponential moving average over the next couple of weeks. Now, something to keep in mind about August going into September, October, and November are two things. One, we don't have an FOMC meeting in August. We have one in September. So you can see a little bit of exuberance in the overall market as the Fed is kind of analyzing the data, kind of letting things sit as they are and kind of seeing, well, where do we need to push interest rates further in order to kind of get these inflationary pressures under control and get our economy back on track. The second thing is that, again, I don't want to get political here. That's not really the conversation, but we do have midterm elections coming up towards the end of this year too. So that is going to play a role on some of the things that you're going to be hearing said in the news from the Fed that could end up propping up the markets. But again, if you think about what has actually changed, nothing really has changed in the overall market here. The same issues are still persisting. Now, when we take a look at the SPY on the daily time frame, which is going to give us a little bit of a better indication here, well, we're seeing the RSI got overheated, came above 70, so the relative strength of this move got really hot. It was way overbought. We're slipping down below the moving average here, approaching that 50. We're seeing the MACD, which is a great indicator of momentum, starting to fizzle out here as well. Now, again, going out to an even longer time frame here, you're going to see something a little bit interesting as well. You see this level of previous support turning into new resistance here, and you are starting to see the SPY slip back down on the weekly time frame. And again, guys, if you do want more insight in basically how to trade and on a day-to-day basis, whether it's swing trading, whether it's day trading, we have the most powerful retail investor geared algorithms for you guys. One of them, Pythagoras, is up almost 40% in the first month of trading. We have Invictus, the predictive algorithm on the 5-minute time frame, the alerts on over 450 stocks, cryptos on multiple time frames, the learning curriculum, the over 65 private live streams every single month. If you guys are interested in that, make sure you check out that link down below. And looking at this chart here again, you did see that bounce off the 200 EMA, and you could easily see this start to slip back down. But that's kind of technically what the market is looking like here. We went on a nice run, it got overextended, and now it looks like it's very possible that we are going to be coming back down. It may not be right now, but eventually, as we are going to see when we take a look at some of this data here and what kind of environment we are actually in, we are definitely not out of the woods yet. The first thing that we have to take a look at here is this. In a Tuesday note to clients, Bank of America analyst Savita said a sustained bull market remains unlikely, even though the S&P has surged more than 16% to 4,262 points since hitting a low this year on June 16th, the day after Fed officials authorized the biggest interest rate hike in 28 years to combat decades-high inflation. Subramanian and her team track a long list of indicators: Fed cutting rates, unemployment rising, that help signal the start of a bull market, but so far, just 30% of those items have been fulfilled. Historically, 80% of the list is checked off before markets bottom out. Here is the important part here. In particular, they write that no bear market since 1935 has ever ended when the CPI, the Consumer Price Index, and the S&P's average price to earnings ratio, or PE ratio, add up to 20 or more, a phenomenon called the rule of 20 that signals stocks still remain too expensive relative to their earnings and likely have further room to fall. What this is essentially saying is that the market has decided that in general, certain stocks and a basket of stocks, if you're looking at the S&P 500, is worth X amount. But what those companies' earnings are actually telling you is that those companies aren't actually worth what the market is saying they are, and it's still overvalued. Now, again, you can look at those metrics of fundamental value and say that they're outdated and they still don't really apply. But at the same time, people have been saying that for a while, and none of these rules have really been met since 1935. Now, the second thing that we need to talk about here is, again, going a little bit on the technical side of things, and we take a look at this right here. This is the chart of the S&P 500 now in white, and in yellow we have the chart of the S&P 500 in 2008. As you can see here, we are tracking pretty closely to what we were seeing back in 2008. And again, even when you think about the timing and the seasonality of things here, it does make a lot of sense that we could be coming down in Q4 or Q1 of next year. So looking at this chart right here, again, everything is sort of lining up and saying that we have not necessarily bottomed out yet. But that's not necessarily the most important part. You have to think about the type of environment that we are in right now in a very specific way, and it's very, very, very simple, and it has to do with a very simple valuation metric called the discounted cash flow model. Now, over the past year and a half or so, before the Fed started raising interest rates, we were in a decreasing interest rate environment. Our interest rates were essentially zero, and that allowed for a lot of growth. Now, at this point in the market right now, we are now in a rising interest rate environment, but nobody really understands what that means, or at least the average person doesn't necessarily understand what that actually means for equity prices. Now, in short, being very, very, very simplistic in our explanation here, when we look at what a discounted cash flow model is and what the equation says, is you can look at these cash flows here listed at the top: cash flow 1, cash flow 2, and cash flow N, as essentially the yearly projected cash flows of any given company in perpetuity. It's usually going to be about 10 years. But when we look at some of these cash flows here, they're always going to be projected out at a certain growth rate, or zero growth rate, or even a negative growth rate. But that's not necessarily the most important part here. The most important part is the denominator, the discount rate. When the Fed raises interest rates, when you go into this rising interest rate environment, you start to see these discount rates go up. What that means is that when these rates in the denominator of these equations are going up, the DCF, or the present value that you're getting for these companies, goes down. So as long as we're in a rising interest rate environment, it's going to be very difficult based on earnings for these companies to see sustained runs, especially if they're more of a small cap, medium cap growth company, whose present value is heavily weighted on future cash flows and future projections that the market is saying that these companies are most likely going to generate. That's why value stocks tend to do well in environments like this, because they have slow and steady cash flows. So at the end of the day, there's a couple of things that we need to keep in mind and think really realistically about what we're seeing in the overall market. Yes, we just went on a nice run, but why? You have to ask yourself, why did we just go on this pretty significant run? And what has changed to allow these movements in the market? In my opinion right now, we are not out of the woods yet. We are still seeing very high inflation, still in a rising interest rate environment. We are still seeing the Russia and Ukraine conflict still persist. The supply chain issues are still here. There are still a lot of of things that need to get resolved until we can see the overall market get back to that normal, steady growth. So guys, that is going to wrap up this update on kind of the state of the market and the overall economy here. If you did enjoy the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who do want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. Other than that, guys, I'll see you in the next one. Peace.